The market's been, well, a bit of a wild ride lately, hasn't it?
Definitely.
We saw this big 1,000-point swings in the Dow back in April, mostly tariff chatter. It really makes you wonder, where can you find something a bit more predictable?
Absolutely. That kind of volatility, it really drives home the need for strategies that offer some, maybe, stability,
Hmm.
like focusing on companies that consistently give back value to shareholders.
Yeah.
Dividends, basically.
Right. So that's exactly our mission for this deep dive. We're looking at an article from The Motley Fool. It just came out April 27th, 2025. It highlights some dividend stock ideas they think are smart picks right now.
Mm-hmm.
And we're going to focus on two of them, Realty Income and Coca-Cola. Sort of explore how, say, a hypothetical $2,000 might fit into this picture, especially with the market being what it is.
Yeah, and they're interesting picks. Very different businesses, of course, but both have pretty compelling stories when it comes to consistent income for investors, which is exactly what a lot of people are searching for.
Okay, so let's kick things off with Realty Income. Ticker is O. They actually call themselves the Monthly Dividend Company.
Which is bold.
It is bold, but I mean, look at their record. The article mentions, 658 consecutive monthly dividends?
That's right, 658. And they've increased the dividend for 30 years running.
30 straight years. Wow. And the current yield is 5.5%.
Yeah, around 5.5%. That monthly payout alone is a big draw,
Okay.
especially if you're trying to generate regular passive income.
Definitely.
But what's really fascinating is the how. How do they do it? And that comes down to their business model. They're a REIT, a real estate investment trust.
Okay, a REIT. And the article talks about these triple net leases they use. Can you unpack that a little? Sounds like the tenants handle a lot of the usual landlord stuff.
That's exactly it. With the triple net lease, the tenant pays for, well, pretty much everything beyond the base rent, property taxes, insurance, maintenance.
Ah.
So for Realty Income, this means their rental income stream is much more predictable, fewer operational costs and surprises for them.
Makes sense.
And it can work for the tenants, too. They might get slightly lower base rent, they get more control over the space, customize it, maybe lock in longer leases. It builds in stability.
Right, stability on both sides. And Realty Income isn't small scale, is it? The article mentions over 15,600 properties.
It's huge. Across all 50 U.S. states, the U.K., several other European countries, too.
Wow.
And look at the types of businesses they lease to. That's also really key. They focus heavily on what you'd call non-discretionary retail.
Like essential stuff.
Exactly. Convenience stores, grocery stores, home improvement, dollar stores. Places people tend to shop at, regardless of whether the economy is booming or contracting.
Because you always need milk or light bulbs or whatever.
Precisely. These businesses tend to be more resilient, and the article also noted they're expanding into newer areas like gaming properties and data centers.
Oh, interesting. So they're not just sitting still. They're looking at future growth, too.
Yeah, it shows they're thinking ahead, diversifying into potentially high-growth sectors.
Yeah.
But, whenever you see a high yield like Realty Income's 5.5%, the big question is always, is it sustainable?
Right. Can they keep paying it?
And the article points to their adjusted funds from operations, or AFFO. That's the key metric here.
AFFO. Okay, I've heard that's the one REIT investors really focus on. It's supposed to be a better measure of the cash actually available for dividends than just, say, net income.
Exactly right. Think of AFO as the actual cash generated from their property operations that they can distribute. And Realty Income consistently generates enough AFFO to cover that dividend.
So what's the payout ratio look like?
Well, as a percentage of AFFO, the article says it was around 75% in 2023. And maybe 76% forecast for 2024.
So they're not paying out every single penny they generate. There's a buffer.
Healthy buffer, yeah. It suggests they aren't stretching finances just to make the dividend payment, which is reassuring for sustainability.
Okay, so Realty Income seems pretty solid, built on that monthly payout promise and the triple net lease model. Let's switch gears now to a name everyone knows, Coca-Cola, ticker KO.
Ah, Coke.
Yeah. It's kind of interesting to see it highlighted as a top dividend pick right now alongside the REIT. The article makes sure to mention it's a longtime Warren Buffett favorite.
Which always gets attention, doesn't it? Buffett loves established companies, strong brands, durable advantages, and Coke fits that bill perfectly. Their dividend history is just, well, remarkable.
How remarkable.
Get this. February 2025, they approved their 63rd consecutive annual dividend increase.
63 years of raising the dividend every year.
Every single year. for over 6 decades.
That's incredible stability. And the article mentioned the total payout number, too, something huge since 2010.
Over $93 billion paid out to shareholders just since 2010. It's massive.
Wow. And the stock itself has been doing well this year, too, right? Up over 18%, beating the market average. The article called it a port in the storm.
Yeah, that outperformance kind of shows how investors see it.
Yeah.
You know, as a reliable consumer staple, when things feel uncertain, like with all this tariff talk, people still buy Coke.
They do. The brand recognition is just global, everywhere.
Absolutely.
Yeah.
And it's not just the classic Coke anymore, is it? Their portfolio is much broader now. Water, juices, even moving into alcoholic beverages.
Right. That diversification probably helps them weather shifts in what people want to drink.
Definitely. And the article brings up their operational flexibility, too. Like if aluminum tariffs make cans really expensive.
Yeah.
Well, Coke has the scale to just shift focus, maybe push plastic bottles more. That adaptability is a huge strength for a company that size. Plus, their recent financials look pretty solid, strong revenue growth, especially in the core sparkling drinks.
So like Realty Income, it sounds like Coca-Cola has the financial foundation to keep those dividends flowing. The article talks about free cash flow and earnings covering it.
Yeah, let's look at the numbers. For 2024, their adjusted earnings payout ratio, so dividends as a slice of their earnings, was about 70%.
Okay, so still leaving roughly 30% of earnings in the company for other things.
Right. Reinvestment, growth, paying down debt, whatever. And their adjusted free cash flow, the actual cash coming in was about $10.8 billion in 2024. That's after factoring out a big one-time IRS charge they dealt with.
And how much did they pay in dividends?
About $8.4 billion. So that $10.8 billion in free cash flow comfortably covered the $8.4 billion they paid out. Plenty of coverage there.
Okay, so it seems both Realty Income with its monthly checks and real estate model and Coca-Cola with its global brand and long dividend history are showing signs of, well, reliability, especially when the market feels shaky.
Exactly. And if we bring this back to you, the listener, maybe the learner in this case, what's really useful here is seeing how these two very different companies achieve that.
Right. Different industries, same goal.
One through stable long-term property leases on essential businesses, the other through just immense brand power and consistent consumer demand, pretty much worldwide.
And hopefully digging into this gives you some of those, aha moments. Understanding the why behind it, the triple net leases for Realty Income, Coke's huge portfolio and history, seeing those payout ratios, the AFFO metric, it makes their stability feel a bit more concrete, maybe less overwhelming than just looking at stock charts.
Yeah, it helps you grasp the underlying business strength that supports those dividend checks.
So, quick recap then. We looked at Realty Income, the monthly dividend company, 30 years of increases, that solid 5.5% yield, all built on that triple net lease foundation with essential retailers.
And then Coca-Cola. 63 years of dividend hikes, huge global brand, operational flexibility, and strong cash flows, easily covering its payouts. A real consumer staple stalwart.
Both offering potential paths for navigating this volatile market through dividends, aiming for that passive income stream.
Absolutely. There are strong examples of that strategy in action.
Okay, so here's a final thought for you to maybe chew on. We've looked closely at these two, a REITs and a beverage giant. What underlying principles really connect them as reliable dividend pairs right now? And, thinking beyond these two, what other kinds of companies, maybe in totally different sectors, might share those same core qualities? Strong business models, predictable cash flow, a commitment to shareholders, something worth exploring further in your own research. Thanks for diving deep with us today.